Welcome to this question. You have 15 minutes to read the question. You will identify when we look at group entities. I prefer to make use of different colors for my different entities to ensure that I understand the group structure. Let's read. Timber Group is a company that specializes in the manufacturing and installation of blinds and security shutters. Timber Group is listed on the Johannesburg Stock Exchange and has a 30 June year end. On 1 September 2018, Timber Group acquired a 65% controlling interest in Oaky Woody Limited. Immediately identify Oaky Woody will be a subsidiary. We need to apply our principles of IFRS 3 at acquisition date, and then we will have to consolidate in terms of IFRS 10. Oaky Woody Limited supplies eco-friendly and sustainable products to manufacture Oaky Woody blinds. Timber Group will be settling the purchase price at the dates as specified below. Right, now when we look at IFRS 3, what is the main thing that you need to remember? The consideration paid by the parent to the previous shareholders of the subsidiary should be at fair value at acquisition date. Our acquisition date is 1 September 2018, and all identifiable assets and liabilities included into the group at acquisition date should be at fair value. They indicate to us on 1 September 2018, which is our acquisition date, 800,000 in cash. Timber Group will issue 30,000 ordinary shares in Timber Group to the shareholders of Oaky Woody Limited. We need to obtain the fair value of these shares and then issue 56,000 mandatory redeemable 8% cumulative R2 preference shares in Timber Group. The preference shares are redeemable 3 years after acquisition date at a premium of 5% on the face value. Therefore, we need to determine what is the present value of these shares. Now remember, the premium, if they indicate to us premium, the future value will increase with a 5%. Then financial assets owned by Timber Group with a carrying amount of 280,000 Rand and a fair value of 336,000 will transfer to shareholders of Oaky Woody. Remember, at acquisition date, therefore we need to use the fair value. Then included in the 800,000 cash payment is 14,800 share issue costs related to the 30,000 issued ordinary shares and 17,000 acquisition related costs in respect of valuations and lawyers' fees. Timber Group expensed these amounts in the separate financial statements. Right guys, if you're not sure, you need to refer to IFRS 3 paragraph 53. This should be expensed. Therefore, we need to take this out when we determine our consideration. Then they indicate to us on 31 August 2020, 300,000 Rand cash depending on the following. Now, when we read this, remember, Timber Group will have to pay. Therefore, in terms of this will be a contingent consideration. Why a contingent consideration? Because it depends on the following. They indicate to us the profit before tax of Oaky Woody Limited for the year ended 30 June 2020 increases by at least 5%. The fair value of this obligation was deemed to be 130,000 on 1 September 2018 and 140,000 on 30 June 2019. Right guys, remember principles of IFRS 3, the consideration should be at fair value, therefore this 130,000. The increase in terms of the 10,000, this relates to the separate records of Timber Group. Guys, you need to ensure that you understand. When I indicate separate records, I mean the annual financial statements of Timber Group Limited, not consolidated. Right. All the assets and liabilities of Oaky Woody Limited were deemed to be fairly valued at acquisition date, with the exception of the following. Inventory was overvalued with 58,000. Important, therefore, in our at acquisition section, we need to decrease the inventory with the 58,000, and we need to remember our tax. At 30 June 2019, 60% of the inventory was sold to unrelated third parties. Therefore, we will then have to reverse 60%. Oaky Woody Limited has a unique customer list that consists of detailed information about customers. Therefore, guys, when you identify customer list, can you touch this? No. Intangible asset. The customer list's terms of confidentiality prohibits Oaky Woody, very important, from selling this list. The fair value of the customer list on 1 September 2018 amounted to 265,000. The customer list has an indefinite useful life. Now, guys, when we identify that, it prohibits them from selling this. Remember, when you think about your intangible assets, your identifiable assets in terms of IFRS 3, it has to be identifiable. Now, identifiable in terms of IFRS 3, it has to meet the separability criteria, or it has to be a legal, contractual criteria has to be met, separability or legal. But due to the fact that they indicate that there is a clause that they may not sell this, guys, we cannot add value to this in terms of an intangible asset. Therefore, we may not include this in the at acquisition date in terms of the assets and liabilities. Third bullet point, Oaky Woody Limited manufactures Oaky Woody blinds that have a unique shape. Before the date of acquisition, Oaky Woody Limited incurred development costs of 170,000 Rand. Concerning the development of a trade blind with a unique color, shape and package design for these blinds, Oaky Woody Limited expensed these development costs when incurred. Correct, guys, in terms of IS 38 and internally generated asset. Remember, your research costs should be expensed, and guys, only once the criteria is met in terms of internally generated assets, we can capitalize the development costs, and this is in the separate records of Woody Oak. Very important. The registration of the trade blind was not finalized at the date of acquisition, and the fair value was therefore estimated at 230,000 Rand on 1 September 2018. Therefore, on 1 September 2018, we need to include our fair value. On 1 September 2018, it is expected that this trade blind will have a useful life of 5 years. The trade blind was registered on 30 November 2018. Oaky Woody obtained the official valuation report of this on this day, which indicated that the fair value of the trade blind amounted to 250,000. Therefore, we need to identify that we have a measurement period adjustment. Why? Because at acquisition date, they've indicated to us that it was not finalized. And then they indicate to us, but now we have the final fair value. Next bullet point. On 1 September 2018, a liability with a fair value of 155,000 was correctly recognized in the consolidated financial statements of the Timber Group in accordance with IFRS 3. This liability relates to a legal claim instituted against Oaky Woody Limited. The previous shareholders, important guys, agreed to reimburse Timber Group for 45% of the damages payable if the legal claim against Oaky Woody is successful. The claim will not be deductible for taxation purposes should it be successful. The fair value of the contingent liability remained unchanged at year end. Guys, they indicate to us in the group that they have correctly included this liability. But now there is a possibility of an asset, money being received, should they have to pay these damages. Therefore, this is an indemnification asset, and we will have to recognize this at acquisition date. No additional assets, liabilities, or contingent liabilities were identified at acquisition date. Oakey Woody Limited revalued their investments in equity instruments on 31 August 2018. This was the only revaluation on investments in equity instruments that Oakey Woody Limited performed during the current financial year. Therefore, guys, we need to determine what is the policy, accounting policy in terms of the equity instruments. If they have revalued this, mark-to-market reserve, fair value adjustments, we don't know. Since the date of acquisition, Timber Group, which is the parent, has been selling inventory to Oakey Woody Limited at a profit of 20% on cost. Therefore, we are able to identify that our profit will represent 20%, our cost will represent 100%, and our selling price will represent 120%. Therefore, guys, the parent sell to the subsidiary. You will not include this in your subsidiary's analysis of owner's equity. This will not have an influence on the subsidiary's profit. There will be unrealized profit in the parent's records. Inventory purchased from Timber Group still on hand at year end amounted to 148,560. Total sales from Timber Group to Oakey for the current financial year amounted to 256,000 and included in the separate records of both Timber Group and Oakey Woody on 30 June 2019 is an amount of 62,200 that Oakey Woody owes Timber Group for inventory purchased on 30 June 2019. Therefore, we need to take this out. We need to eliminate this. Right, guys? Intra-group transactions, always to remember the tax effect, please. Then they indicate to us on 1 February 2019, Timber Group sold, again, our parent sold equipment with a carrying amount of 88,400 to Oakey Woody Limited, to the subsidiary, for 120,000 Rand. The equipment had a remaining useful life of 3 years on that date. Again, guys, we will have our unrealized profit, and we need to remember our tax, and remember, due to the fact that this is equipment, the profit will also realize, and we need to remember our tax. Cherrywood Limited. Cherrywood Limited is a well-established company that manufactures quality security shutters. On 1 January 2017, Timber Group acquired 35% interest in Cherrywood Limited for a cash consideration of 210,000 Rand, as well as the transfer of equipment. The equipment transferred to Cherrywood Limited at the date of acquisition had a carrying amount of 99,000 Rand and a fair value of 126,500 on 1 January 2017. This equipment had a remaining useful life of 3 years on 1 January 2017. In addition to the cash payment of 210,000 Rand, Timber Group also paid lawyers' fees of 11,000 Rand on 1 January 2017. from 1 January 2017, Timber Group exercised significant influence over the financial and operating policy decisions of Cherrywood Limited. Therefore, immediately we know IS 28, guys, Cherrywood will be an associate. Therefore, we need to include the net investment into our group. You need to know your principles, guys, please. And then this 11,000, we will have to capitalize. We need to include this. They indicate to us Cherrywood Limited's equity consisted of the following on 1 January 2017. Ordinary share capital of 100,000, retained earnings 861,476, and a revaluation surplus. Why is this important to us? Remember, in the separate records of our investor, which will be Timber Group will debit the investment and credit bank and credit the asset, right? Therefore, this is included in the separate records at cost. But in terms of our group, when you look at the right side of your screen, in terms of our group, if there is any goodwill, we do not recognize goodwill. But if there is a gain on bargain purchase, we need to capitalize this against our investment. All the assets and liabilities of Cherrywood were deemed to be fairly valued at acquisition date, and no additional assets or liabilities were identified. During the current financial year, Cherrywood Limited, which is our associate, sold inventory to the investor, Timber Group, at a gross profit percentage of 25%. Therefore, we can assume based on this, our selling price will represent 100%, as our profit will represent 25%. Included in Timber Group's inventory on hand on 30 June 2019 is inventory amounting to 143,000 in respect of purchases from Cherrywood. Remember, our associate sell to the investor. Therefore, there will be unrealized profit included. Let me just write this out. Unrealized profit included in the profit or loss relating to our associate. And as always, guys, you need to remember your tax. Timber Transport Limited. Timber Group is in the process of incorporating a new company, Timber Transport Limited. In accordance with its proposed memorandum of incorporation, Timber Transport Limited's agreed purpose will be to perform administrative and operational activities necessary to run a delivery scheme for Timber Group. In accordance with this scheme, 80 employees who had been employed by Timber Group will become shareholders and employees of Timber Transport Limited. Timber Group plans to acquire 35% of the ordinary share capital and voting rights of Timber Transport Limited. The remaining 65% of the ordinary share capital will be allocated equally between the 80 employees. Each ordinary share confers one voting right to the shareholder. The 80 employees have an agreement to vote in unison together. The relevant activities, remember this is important to us because when we look at control, we need to determine if there is power in terms of the relevant activities that will influence the return. Relevant activities arranging financing in order to purchase 40 delivery vehicles to be used, purchase of delivery vehicles to be used by the employees, and insurance for and the maintenance of the delivery vehicles. As per the Memorandum of Incorporation of Timber Transport Limited, the Managing Director can make all decisions relating to the operations of the company, including those relating to the activities described above, except for the selection of insurance and maintenance companies that should be used by Timber Transport. Timber Group will have the right to select insurance and maintenance companies which Timber Transport should use. Therefore, when you look at the bullet points, guys, the third one, Timber Group will have the right to select this. Mr. J. Johannes, one of the employees, was elected as managing director by a majority vote by the other employees. Other financial information. The following is an extract from the separate trial balances of the different companies as at 30 June 20.19. Based on this, they provide us with the parents' details. Timber Group, we have Oakey Woody, we know that this is a subsidiary, and Cherrywood, which is the associate. They provide us with the ordinary share capital, preference share capital. Guys, important to identify, none in Oakey Woody and none in Cherrywood. Retained earnings, this is on 1 July 20.18. Mark-to-market reserve on 1 July 20.18. Revaluation surplus 1 July 20.18. Then they indicate to us that there is property, plant and equipment, investment in equity instruments, inventory, cash and cash equivalents, trade receivables, trade payables, long-term borrowing, deferred tax, profit after tax for the year, a fair value adjustment on investments in equity instruments, gain on revaluation of land, and dividends paid on 30 June 20.19. Right, now remember, in terms of the dividends, we need to eliminate the intra-group dividends, and our associate, the dividends will decrease the net investment value in our group. Additional information. It is the accounting policy of Timber Group Limited. Guys, identify, this is the separate entity, not the group, the separate entity, to account for investments in subsidiaries and investments in associates at cost in accordance with IAS 27 paragraph 10a in its separate financial statements. 2. It is the accounting policy of all the companies in the Timber Group Limited to account for all other investments in equity instruments in accordance with IFRS 9 financial instruments. All the companies in the Timber Group irrecoverably elected to present subsequent changes in the fair value of these investments in other comprehensive income in a mark-to-market reserve. 3. All the companies in the Timber Group Limited have a 30 June year-end. The fair value of the ordinary shares of Timber Group was 18 Rand per share on 1 September 20.18. Remember, we have identified that as part of the consideration, Timber Group transferred 30,000 shares. We need the fair value of these shares. 5. Assume the profits of all the companies in the Timber Group accrued evenly throughout the respective years. 6. An appropriate pre-tax important discount rate is 9% per annum, compounded annually. You can correctly assume that a consolidated deferred tax liability was recognized in the consolidated financial statements of the Timber Group Limited for the year ended 30 June 20.19. Guys, we can assume that there is a deferred tax liability. 8. There were no changes in the issued ordinary share capital of Oakey Woody Limited or Cherrywood Limited. It is the accounting policy of all the companies in the Timber Group Limited to account for property, plant and equipment according to the cost model and land according to the revaluation model. 10. Timber Group Limited elected to measure non-controlling interest at proportionate share. Remember, this is important to us. If at fair value, our NCI will share in goodwill. 11. Assume an income tax rate of 28% and capital gains tax inclusion rate of 80%. Ignore value added tax and dividend tax. Right, let's have a look at the requirement. the first opportunity when you are allowed to write, please allocate the minutes to each section. Remember that this will be the marks times 1.5, and this will be the minutes that you are allowed to spend on each section. Therefore, when you look at requirement A, 30 marks, you are allowed to spend 45 minutes. B, 3 marks, 4.5 minutes, round this down. And C, 7 marks, therefore 10.5 minutes. Right, let's briefly read through the requirement. A, prepare only the assets section of the consolidated statement of financial position of the Timber Group Limited as at 30 June 2019. Communication skills, 1 mark. B, discuss with reasons how the customer list of Oakie Woody Limited should be accounted for in the consolidated financial statements of Timber Group Limited, 3 marks. C, discuss with reasons whether Timber Group Limited will have power. Look at this, guys. Will have power. We need to focus on the word power over timber transport. Remember, this is in terms of our principles of IFRS 10. If there's power, we will be able to identify that there might be control. Communication skills, 1 mark. B, the customer list relates to our principles of IFRS 3. Please note, round off all amounts to your nearest rand, show all your calculations, and your answer must comply with IFRS. Guys, as always, when you look at this, requirement A, plan how you are going to attempt the section.